Okay, so today we look at how to beat the market. So I said that's the essence of being an active investors. That if one is not doing better than the market, then then there's no point of like actively participating in the market. That is, it's better to just go with the S&P, meaning just like a cost average into the S&P. That's the market itself. But if one is actively participating, then one should be able to figure out a way to do better than the S&P performance. So now, it doesn't mean that every year one must beat the market, but on average, one should aim to do that on average. Meaning, if this year I beat it, last year I did, next year I did. If the next other year don't work out, then one can check, like look at your strategy. But I'm of the opinion that is, if one is actively participating, as you know, you are actively involving your investment. If you can't do better than what the S&P is doing, then probably that's just a waste of time. What's your thought, sir?
I agree with you. I agree with you. I agree with you.
Okay.
To try the best we can do is to try and be above that mark if we're going to spend more time on it. I agree. So I agree with that
Okay.
analysis.
In the beginning, one may not, but I'm just saying if one's gonna be actively participating, then the aim should be as in the purpose, the essence of actively participating. When I say actively, I mean you are researching, okay, so, but if the strategy one is using is not really performing better than the S&P, then probably it will be a good idea to just stay with as in just buy the S&P and, just, that's still good, that's still a good return too. But I'm just saying, if one is actively participating, then one should learn or figure out a strategy that will outperform the market. All right, so before we go to how I've been doing it, or as my own opinion how to do it, and last year, oh, anyway, when I say the way the reason I said no, it's not 2025. So when I said last year, I'm referring to 2023.
Okay.
So 2023 I actually make 150%.
Wow.
Okay, so I mean the money I put in I actually made more than that. So last 2023 I 150% of the money I put in.
Nice.
2024 52.11 or 18, the one I posted.
Oh
As
yeah.
in, so okay, so 2024 52 point something. So this year, but every year I'm just aiming at 20. As you know, that on average, if I could make a profit of 20%, that would be in the same league with Warren Buffett. As in, usually it's the average 19, 22 when they, not now. As in when they started, when I say not now, when they have so much money, it becomes difficult for them to be able to get that kind of return. So at this point, they told they are okay with whatever they can get. Okay, so somebody say you get rich you get rich by making a lot of profit on a small amount of money, but you stay rich, by just making little on a lot of money. So at this point, they have billions of dollars. So 6% interest, 7% is okay with them now. But in those days when they started, they actually averaging 19, 22 or that. But for now, and last year they actually did around 23, 20 something. But I'm saying for now they are okay. We just 6 or 7% because mostly they invested in bond.
Okay.
They have a lot of their a lot of their money too as just cash that they are just holding. So many they are okay with that at this point because they are they've done all those research in those days. For now it's not easy for them anymore because they have a lot of money and there is not a lot of opportunity to invest in. So they are okay with whatever the federal government is offering on the bond, 4%, 5%. So, but before we move on to like a strategy that I've been using, so last week we talked about like risk assessment, So when we're looking at risk assessment, there are different way of going about it. So first we talk about conservative investor. So at this point now, we can say Warren Buffett, they are not conservative, that is, they are not like, going, they want to really be sure, as in they would rather preserve their money now than going after gain and losing the money. So we can say at this point, they are like conservative. So they prioritize safety and stable return, and they accept lower return to minimize potential losses, e.g., bond, CD, and stable stock. So at this point, as in their company is doing fine, when I said their company, the Warren Buffett company is doing fine, but the other investment they are making and they are more conservative, that is, preserving the money than rather than losing it. Then we have moderate investors. So for moderate investors, they seek a balance between risk and reward. They tolerate some fluctuation in the market, e.g., they have a mix of stocks and bond. And lastly, we have aggressive investors. So this is the point we're looking at now, that if you want to be aggressive. Anyway, let's leave the aggressive alone. Let's just go as in, let's talk about beating the market. The reason I said that being as in, you do not necessarily have to be aggressive to actually beat the market.
Hmm.
Okay. So, but we say aggressive, they are comfortable with higher risks in pursuit of higher return. They may invest in more volatile assets, e.g., growth stocks and emerging markets. But at the end of the day, being aggressive, that's just a definition, but I will stay with like moderate, that is, as in you just in between, that is when you see the opportunity, you take it, and as well as being on the safer side. So for me, I will stay with being a moderate investor. That is, I'm actively I'm actively following the market. I'm researching it. When I see opportunity, I take it, but I still want to stay on the safer side. So for me, I would say I'm like a moderate moderate investor at this point. Because being aggressive sometimes is because you don't know so much about how the market works and you can lose so much money. So the essence of doing all of this is actually doing better than the average, which is the S&P. So let's talk about risk tolerant journey, then we will now move to how to beat the market as in step that I've been taking. And that I think if you, as you know, a way that you can apply it. So we're talking about risk tolerance journey. We say it's not, how do they put it? It's not set in stone that one can be amending it. You have to be concrete on your goal, but you can be flexible on implementation of the goal. That is the step that one will take to achieve the goal. One can be flexible, but you have a goal. You have a concrete goal. By achieving it, one can be flexible. As in, do you have any thought about that? As in, you have a concrete goal, by achieving it, you can be flexible on how you achieve it.
Yeah, I think that's very important to work according to the plan, to work according to flexibility, because you can't be too rigid when it comes to
Okay.
certain things in life. You cannot be, because end up hurting you more than helping you. So I
All
just
right.
think that one has to be with wisdom in knowing which one is better, to when to be aggressive and when not to.
All right. All right, so but as in, so we are saying that risk tolerance is not set in stone, so it's okay for one to adjust it based on one situation. So we say risk tolerance can change over time due to life event, due to your financial goal, and your market experience. So when I started like 2020, I didn't know so much about the market. I just read the podcast I was the YouTube video that I was listening to. I just heard that if you don't get involved in Bitcoin now, you may regret it.
Yeah.
So, and I started reading about how to get involved, Robin Hood and all of that. So I started. And within 3 weeks, I made like over 50 or 20% gain. I was excited. I thought, as no, so that's like limited knowledge. I thought that's how it's gonna continue to go. Then I put so much money into it, but in 2021, I lost a lot of money. So then that's when I realized that this thing wasn't like what they said, what I thought it's gonna be. But instead of giving up, I started reading books. But usually that's what I do. As in when I say usually, when I'm into real estate, it's books that I got that government started in real estate too, and books that kept me going. As in, I don't attend so much event, but I do read a lot of books, as in about whatever subject that I'm interested in. So I started, like reading how to read the chart before. I don't even know what it's called. I don't know what is 200 moving average. As I do not understand anything about those charts before, but I started reading and MACD, Fibonacci, as all kind of technical thing. But at the end of the day, all of those didn't really help me, but they are still helpful. As in, at least when I look at the chart now, I understand what they are saying. But at the end of the day, after reading all of those and keep practicing, I come up with what works for me. So the fundamental of the stocks as well as the technical. So I read the chart, but that's not how I really make my decision. I choose the stock that I'm gonna buy based on the fundamental. Then the chart will tell me when to buy it. But that comes with experience, meaning like after about 3 years of doing it. And I now like settle for that. At least I already have companies that I know they have good fundamental on my watch list. Then the technical aspect is now waiting for a good time to buy them. So mostly now I don't reach that company every day. I already have them on my watch list, but I'm only waiting for a good time to buy. As in, there are new companies that are coming up. For now, I don't buy new company as I like leaders in that sector, in that industry, those that have been established. But I'm just waiting for a good time when they are at discount to buy them. So we say you can adjust your investment strategy as you gain more confidence. Ah, okay, now so this is my own 2 cents. As in, this is my this is how I've been doing it, and I think it could be helpful how to beat the market. So based on your as in how long have you been involved with the stock market, sir?
Man, a long time, man. I've been trading.
Oh, okay.
I've been actually, uh, I can't even over 10 of almost 15 years. But of course, everything goes in stages and stages.
Oh, okay.
Yeah, everything goes in stages. I've been involved in a lot of instruments.
Oh, okay.
Yes, but the last I believe is 2021 is when I actually start saying that let me start picking a direction on the let me start building and learning and actually trading and trying to become profitable. It's a different
Oh,
story
okay.
entirely.
Okay.
So, but
All right.
I've been training for a while, and I'm hoping really working on trying to now hone the skills.
Oh, okay. Yeah, I mean, before all I know about stock market is where you go to lose money. So, as in when people mention stock market, that's what I thought. As in people lose money there. At work, as you know, for retirement, I put a little there, but it's like 2020. I mean, so what I focus on since 2008 is, or 2005 is real estate. As in, that's what I thought that can like a good, a good investment or a good sector to focus on. So I've been involved with real estate since 2005. 2008, I got my license as agent in Virginia. I did that all the way to 2022. Yeah, so I represented. So actually, I'm the agent for the church too. That's Chesapeake Church.
Okay.
Okay, I'm actually the one that represented them buying it. So since I've been an agent, I've been managing for people. Just so many things that I've done with real estate. Buy my own house, manage my own rental and all of that. But it's 2020 that YouTube video that I do listen to that they mention Bitcoin. I've heard about it before, but that's when I really got interested in reading and studying about cryptocurrency. Started buying, then little by little, I now moved to stock itself, as you know, the stock market, then learning about it, putting money into it. So anyway, they will say the rest is history. So 2020, 2021, I lost a lot, but 2022, I actually like get involved, meaning like day trading. But at the end of 2022, then I figure out that this actually being an investor, as in investing, is better for me than day trading and figure out how to do it. So we have been making progress since 2023, 2024, and this year too. So All right, so but this is how I've been able to do it for 2 years, but this year too, probably the S&P have gained about 2 or 3%, but I've done about 23 already or something. So all right, so but we're saying how to beat the market. This is the essence of being an active investor. That if one actively involved, like everyday thing. If you are not, no, as in if you have tried for so many years, then probably it may be a good idea to just cost averaging into S&P. You are still involved, at least once they have knowledge of what is going on. But we are talking about you picking the stock now, you choosing the stock that if it's not working for you, then it may be a good idea to just stay with the S&P 500. That's still a good profit or good money too. But this is how I've been doing it. I said one needs to understand how the market generally move. How the market generally moves. So when I say that, like I've mentioned it, that is the market has cycle. As in there is market cycle. That is, there is time that the market is contracting and there is time that the market is expanding. So at this point, it's still an expansion. That is, once they are cutting the interest rate, the market should be expanding under normal circumstances. But when they are increasing or raising the interest rate, then the market will be contracting at that time. So that's one understanding. Is not set in stone, but generally speaking, when the Fed is increasing its interest rate, the market will be contracting. Then when they are cutting it, the market should be expanding. But there will be other innovation that happens like 2023, 2022. It wasn't the cutting of interest rate that actually moved the market. This was artificial intelligence. So sometimes something happen in the market that will bring about the market movement. So all of those, you have a general idea of where the market is. You cannot necessarily say where it's going, but once you have a general idea. And number two, I say one should avoid FOMO, like a fear of missing out. As in, you shouldn't be in a hurry. They are buying it now, everybody is buying. If you don't know so much about whatever they are buying, it may not be a good idea to join them. And once you understand his or our own risk tolerance, that will prevent panic selling. That is, you should understand your own risk tolerance. That is, the stock that I have the portfolio or the stock I have in my portfolio now, you have an idea of a reason why you have those stocks. And if the fundamental of those companies have not changed, there is no need to be panicking when there is when there is up and down in the market. So that's my own experience. That is having a general knowledge of how the market moves, as in like which cycle are we in now. Then you are not really like following the crowd. That is, hey, they are buying this now. I'm joining them. What you buy, you have like a reason for it. When I say reason, fundamentally, you could say one or two things about that company, that this company, this is what they do, and this is what I think will be happening in the future, as in like future, that they will be profitable. And that's your reason for buying that stocks. And number three is you actually understanding your risk tolerance, and that guide you how much money you put in each stock. That is your risk tolerance determine how you divide your money into in stock. So all of those will prevent panic selling. Do you have any thoughts on that, sir?
I just have a question on the one that says your portfolio should not mirror the market. Don't literally
Oh, okay,
pick
yeah, okay.
stocks from each sector. So that's, I would have thought that that would be the truth statement of making sure at least you have an edge. That's why, so I don't understand. Could you explain it better?
Yes, so if I say how to beat the market, then the market is the S&P. So if your portfolio mirror the market, meaning like you just literally like pick a company or a stock from each sector, that doesn't, as in that does not necessarily you are not likely to beat the market. You only just selected from the market. As in, if you just literally that is, I pick one from energy, I pick one from communication, then their performance will still mirror the S&P because that's what the S&P is all about. They pick from each sector,
Okay.
but the as in the breakdown, there is more of technology. As in technology has about 30 something percentage, followed by financial, then real estate and healthcare and all of that. But I'm saying if you to just literally do that, that is, I just pick one from energy, I pick one from communication, then your result will likely be just mirroring the S&P, not actually beating it because you just literally pick from each sector. So I'm saying my portfolio doesn't necessarily uh, does not only comprise a stuff from all of the sector. I have understanding of all of the sectors, but I pick the one that I think as of this year will do better than the average, than the S&P. So meaning for me, I don't have any technology for this year. As in last year, my own my like winning stock, what I call like a star stock, was Nvidia. So I started buying at when it was like 120. I hold it all the way to 1,200. You there, sir?
Yes, sir, yes.
Okay, so meaning like last year, it was NVIDIA that I believe that based on the artificial intelligence movement that is going to perform better than all other in that sector. So last year I was not focusing on energy or anything. It was just NVIDIA that I'm all about. That time I could like, no, when I'm discussing with Brabola, I'll tell him that and that, okay, it's 500. I believe in about 2 months or so it's going to be 7. I'm not sure of the date, but I'm just going to say I believe the next move will be 7. Then when it's 7, then I'll look at it again. I'll think, okay, it's going to get to 900. Then 900 is going to get to 1,100. When I'm saying that, not because I'm 100% sure, but that's giving myself a reason not to say. So many I had it all the way to like 1,100 before I sell and get out and look for another one. So I like September of last year is when I started with Robinhood. And when we talked, you know, but as of yesterday, it's 50 already now. So minimum average is 620. I started
Oh, you didn't
buying
close the
when
position. You didn't take the, you didn't,
I didn't say no. I buy it back. I do the. I didn't sell it.
You rolled it or you
Not like set to buy to close.
oh, okay, okay. You wow.
So that's why I say I share my gain with the people. Anyway, so I
Yeah,
did it at 39, but I wasn't expecting that it's gonna get to 47 in the 1 week because
yeah.
I did sell 47. But hey, guess what? By that Wednesday, we're already 48, 40 something. So, but I still like them. So I had to like buy to close as in. I
Okay,
gave
okay, okay.
about
Wow.
600. I gave about $600 back to the people, whoever
Yeah.
I saw in it, and I still keep the stock. So
I'm still going somewhere.
okay, but I didn't expect that it's gonna get to 40 something that week because it was 39 that time. So I did a 42.5. As in the first one is 42.5, the other one is 47.
Okay.
But it reached 48 by that Friday. So, but that was a tax strategy. As in the reason for not selling is to meet my tax strategy for this year.
Okay.
So, like I said, once you, as in, I don't know what your own tax strategy is, but usually I start from Jan, as in, even now it's on January, if the strategy for this year already planning, like October of last year. So the essence of not letting it go is if I sell it that last week, I will have a gain of 7,000 plus. Then that won't allow me to that will mess up my strategy for this year. Because if I don't sell it, as in if I don't sell, I don't have to pay tax on it yet.
You're right, you're right, you're right.
Okay. So if I let it go that day, I'll realize about 7,500 profit. I can buy it back, as in like buy the stock back, but they will already record the profit. As in you got what I'm saying, right?
Yes, yes, yes.
Okay, so it's when I realized that they will record a profit, then that I decided to do a buy to close instead of them recording profit. So for now, it's like I lost 700. I didn't really lose it, but according to their record, I lost by giving it away. Okay.
Yeah.
Okay, so many that just for tax strategy for this year. That is what I'm working with. I shouldn't make more than 11,000 profit in stock. If I do, then I won't qualify for what I'm pursuing as for tax. So usually I have a tax. I mean, when I'm doing investment too, I'm also having like what I do also have to match the strategy for tax, like how to optimize my tax for that year. All
Uh-huh.
right, so going back to this, as in, I'm just saying one shouldn't literally just pick stock from each one. The stock you picking should be like you have a story. When I say story, like a reason why you think they will do better. Not all of them. So in my own case, it may be just one. So like 2024, it was Nvidia that did better than all, but that one alone was enough. That one alone was enough to carry me to that 52. So all of that one like real estate thing that I have. They did like 10%, 12%, 14%, but when I added everything together, then the average is 52. So it's not every stock that one pick that will do better than the market. So some of them may do poorly, some of them may do on average, but at least out of all those you pick, if you have a star, as in one that actually did like 180, then you are likely to beat the market. So that's my own experience as in like how to beat the market. That is, one should not literally just pick from each sector. You should pick the from you should pick stuff from either a sector that you think will do well or industry. But just picking the stock should be that I believe that this store will do better this year. It doesn't have to be forever. Each, like each year you can rebalance it or each quarter as however you want. But in my own case, Nvidia was 2022, no, 2023, 2024, the way to June. Then from June, I got out of Nvidia and waiting. But by September, I have enough reason to think that Robinhood will do well. Then so Robinhood took me all the way till now. Okay. All right, so do you have any question? I think so one shouldn't literally just pick from each sector, but one should select them based on what you think will happen this year.
Do you consider yourself a trader, investor, or a short-term trader?
No, not a short-time trader, as in,
Or a long-term trader, or because investor you buy usually don't sell out of the position, but for a trader you buy and then maybe 1 year or so you sell out of that position.
and to me, I just, as in, I'm both. It depends on the opportunity, as in, once, like Nvidia, once I know that this, as in, I said it to Bravo that is, I think is last last year that is gonna be trading on range of 120 to 140, and that's what he did. So when I sell at that point, like June of last year, that is, at that point, I just believe it's gonna be going from 120, 140 coming back. So as in when I have a reason that this thing, I think it's just gonna stay this way, then I will get out. So I would say both, as in I'm investing in companies based on their fundamental, then but I will say not because of not based on how long I've been holding it, but if I don't have any reason to keep holding it anymore, then I will say. Or I will say if it meets the tax strategy too for that year. So three things. I don't believe this thing will do well anymore. Two, I will look for a time that it meets my tax strategy without losing money. So both way, as an investor as well as trader, it depends on which one what.
Okay.
All right. All right, so we can end we can end the recording, then we just talk if you have any other question.
Okay.